Good morning, and welcome to our third monthly money meeting. As I indicated, the first one was on budgeting, and it's available on our YouTube channel. The second one was on using credit wisely. And then now for this month in June and also in July, our savings and investment sessions will be happening. And the rationale around the sessions is more around creating that culture of understanding financial literacy and also building the confidence and be able to make better money decisions, not forgetting to praise ourselves for the better money decisions that we are already making, because sometimes we always look at the negative side, but not focus on the positive side and the things that we are able to do and the things that we're able to achieve and the goals that we've set for ourselves that are underway. So for everyone that is here, you can just pat yourself in the back because you're doing well. Even just taking time to be here, it costs money. And as I say, every decision is a financial decision, and you being here, it's money, it's time that you're investing in your own education and being able to better understand when it comes to financial matters. My name is Moralo Nematayeni. I am a certified financial planner by profession, founder and CEO of EmpowerX Advisory Services. And with EmpowerX, we stand for three things. The first one is we believe in our clients' ability to manage their finances. So we're in this with you. We believe that you are able to manage your finances. Secondly, we believe in empowerment through education, and financial education is one of the things that we can use to empower and also emancipate ourselves when it comes to financial matters. And then lastly, we walk the financial journey with you. So we invite you to reach out at the end of the session and then be able to get to know more about how you can better manage your finances. We do financial planning, which is focusing on risk, retirement, and investment planning. We have financial literacy education, which is mostly on financial literacy, understanding the concept, building the confidence, and also being able to touch on those skills that we need when we are managing our finances. And then we also do coaching and mentorship. And for those in the RE space, financial services space, we also do RE, which is regulatory examination training for those that are working as representative and key individuals in this space. So a disclaimer as we start. So we are going to be having this session. It's an open session. Please do not consider this session as financial advice. As I indicated, you're most welcome to reach out should you need assistance with your finances. This is purely for education purposes, and we do not hold the views of either our speaker or also the people that will be contributing in this session, because everyone will have a chance to contribute, share their experiences, ask questions and comments. So don't take those comments and questions as advice. As a financial services provider, we work with different product suppliers. We've got Allan Gray, Momentum, Liberty, Sanlam, South African, and with those, there is products and solutions that are available. But our key thing is before you sign up for anything, you need to understand it. And if you don't understand something, you need to reach out, get the information. So with that brief introduction said, we have a special guest today. The last two, we've ran our own sessions. Today, we're like, this is a special one. So we have invited Emanuela. Emanuela is from Allan Gray, and then we're going to hand over to her, and then she's going to take us through a presentation. And after that presentation or conversation, however she will pen it out, then we are going to open and then have that engagement, the discussion, and then be able to assist one another navigate this world of finances. So thank you once again, Emanuela, for coming through. And I'm going to hand over to you so that you can take us through savings and investments and also what Allan Gray has on offer. Thank you.
Thanks, Milano. If you could just allow me to share my screen. It's saying host disabled participant screen
Okay,
share.
I've done that. Thank you.
Awesome, thank you. So I trust that you guys can see my screen. Thank you everyone for being here this morning. And like Malala said, well done to all of you that have embarked on this journey. You know, we partner with stakeholders such as Malala to give insight into what we deem is important when it comes to saving and investing. So good morning, everyone. My name's Manuela. I am a client relationship manager with Allan Gray. And as I said, our main purpose is to educate people on what we believe is important when it comes to savings and investing. So if you have any questions throughout the session, please, you can jot them down in the chat and then we can answer them at the end of the session, and you're welcome to unmute yourself. So just having a look at the agenda for today, we're going to look at who we are as an institution. We're going to look at the human side of investing. We're going to look at a few tips to help you reach your investment goals and financial success. And then we're going to tell you about what are some of the products that we offer at Allan Gray. So first and foremost, we are a privately owned investment management firm. So we were established in 1973 by Dr. Allan Gray, the man. So just to give you a bit of information about him, he was born in the Eastern Cape. He then went to Rhodes University, where he qualified as a chartered accountant. He then went over to the States, where he obtained his MBA qualification, and then he worked at an investment management firm for a few years, after which he returned to South Africa to establish what we know today as Allan Gray. We are affiliated to our sister company Orbis, which does exactly what we do, but on a global scale. We manage 559 billion Rand of assets for our clients. We have 30 investment professionals in our firm and 1,400 employees. And our main purpose as a company is to help clients build wealth over the long term. So we out here trying to fight the misconception that Allan Gray is for the super elite or for the super wealthy. It's not. Allan Gray is for anyone that wants to achieve financial success and has the means to do so. So how do we go about building long-term wealth for our clients? So we do this through what is called our investment philosophy. And our investment philosophy, very simply put, is we are bargain hunters. So we go out and try to find bargains in the market. And this is where shares or companies are trading below what we deem them to be worth, right? So if I can draw your attention to this graph, the black line represents the market value of a particular business, and very simply put is what a prudent businessman or woman would expect to pay for that particular company. The red line represents the share price in the market, right? And we all know that the markets are volatile and the price goes up and down. And we try and find opportunities where the share price is trading well below what our investment professionals deem it to be worth. And we hold this particular share or company until it reaches its net worth, right? So it's in applying this philosophy for more than now 50 years that we are able to generate long-term wealth for our clients. So those investment professionals that I alluded to earlier, they are responsible in deciding which shares to buy as well as which shares to sell. They try and look at companies holistically. They sit in portfolio meetings. They look at financial statements and look at companies without taking on any more risk for our clients. And it's in applying this investment philosophy time and time again through different market cycles that we are able to generate long-term wealth for our clients. So very simply put, We buy undervalued assets, and we try and avoid assets that we believe are very expensive for our clients. I'm sure you've all heard of the saying, don't put all your eggs in one basket. That's exactly what our portfolios aim to do. This is one of the portfolios at Allan Gray. This is the Allan Gray Balanced Portfolio. And as you can see, it's made of many different companies. So that pie chart indicates all the different companies that we invest in this particular portfolio. And you can see we invest in different sectors, different asset classes, as well as different geographies. So we invest locally as well as offshore. And all this is showing you is the top 10 holdings that we have for our clients. So as you can see there, we invest in Woolworths, Nedbank, and there's small, or what's considered small percentages in these particular companies, right? So in other words, if every single one of these companies had to go bust or would no longer exist, then that would result in losing your money. But as you can see, what we aim to do, and what the point of this is to diversify our assets so that if one sector or one particular company is not doing well, it won't impact the whole portfolio that much, right? So let's look at the human side of investing. So the biggest age-old question is whether to save or whether to invest. And this depends largely on your goals and your time frame. So often people use savings and investing interchangeably and think they mean the same thing, and it doesn't, right? Savings refers to money that we set aside that we don't necessarily intend on spending, right? So we can put it in a banking account, or hopefully we're not putting it under the mattress, right? And then on the other side, we have investing. Now, what is investing? Investing is the act of allocating your money to buy certain assets. So what are these assets? These assets are cash, bonds, property, and equity, right? To buy certain assets in order to generate you an inflation-beating return. And in the likelihood that these assets obviously increase over time. So that's how you're able to grow your wealth or your money in an investment. So speaking of the assets, so what type of assets do we invest in for our clients? These are the basket of assets that we invest in. So cash is the less risky asset, and cash refers to cash or cash-like instruments. So perhaps that is leaving your money in a bank account or having money in a fixed deposit account. That is what cash, the real cash speaks to, right? Bonds, we invest in bonds. Now, bonds are basically like an IOU. So, for example, if we have a particular institution that's looking to raise capital because they want to embark on some kind of, call it infrastructure project, right? So, for example, Telkom want to embark on an infrastructure project. They will then issue a bond to Allan Gray. And what this bond is, it's a promise to say, okay, if you borrow me a large sum of money, I'm going to pay you back in the form of monthly installments for a specific period of time, right? And that is exactly what a bond is. It's like an IOU. The next asset that we could invest in is property, and property just speaks to the tangible asset, like property, right? And then the last asset that we invest in is called equities. Now, equities just refers to part ownership in a company. So equities, shares, it all means the same thing, and that just refers to part ownership in a particular company. So let us delve deeper into the key differences between savings and investing. So if we have to look at the time horizon, savings is more suited for your short-term needs. So if you want to save for between 1 to 2 years, whereas investing, you need to have a more longer time frame, and that is, from 3 years or above, right? Then if we have to come back to savings, savings will provide you with the highest capital preservation, right? But very little capital gains in the long term, right? Whereas with investing, you might run the risk of there being a potential capital loss. However, there is potential for significant capital gain in the long run, right? So in a nutshell, savings will provide you with short-term capital preservation, but it might not generate you the best rate of return or the best interest, right? Whereas with investing provides you with the best expected rate of return in the long term, but in the short term might be a little bit volatile. So as the saying goes, with high risk comes high reward. Same too when it comes to investing. So your decisions when it comes to investing are super, super important. When it comes to long-term wealth creation, there are two key roles. One is what we do as an asset management firm, and that is to provide superior service and outstanding returns for our clients. And the next important role is how you respond as an investor, and that is called investor behavior. And the difference between investment return and investor return is what we call the behavior gap. So let's say, for example, Allan Gray go and finds an opportunity, but this opportunity is only going to come to fruition in 4 to 5 years' time. But the investor decides not to stay the course, right? So they either withdraw their funds before the time, or they switch from one portfolio, to the next. And that just could speak to being invested in the incorrect type of portfolio that is not suited to your needs as well as your time horizon. Right? There's this saying that personal finance is personal, and what's suitable for you might not necessarily be what's suitable for the next person. So when it comes to investing, there is a roller coaster of emotions, right? We have fear, we have greed, and people are often driven by their emotions. So having a look at this graph, the first thing I want you to understand is that shares don't move in a straight line, right? They go up and down in the market every day, okay? So let's say we go to a bar and we hear someone talking about a particular share or stock that's gaining traction in the market. And we want to also get in on this, right? So we rush out and buy the share without considering whether it's suited to our needs as well as our time horizon. And because everyone's buying the share, we are buying it at a premium, right? And then what happens? The share price drops, and fear trickles in, and the investor decides, oh, this is the worst decision I've ever made, and they withdraw their funds. So they lock in those losses, right? So we believe it's best to spend time in the market rather than trying to time the market, because in the long run, shares tend to deliver an inflation-beating return. So in this example, we've bought high and sold low, and the key is to buy low and sell high, right? So it's important to not worry about too much about what's happening out there, what noise everybody's making. There's always going to be these crises on our hands, right? But we need to focus on what is our goal and have a long-term mindset when it comes to creating long-term wealth. So an example of this is exactly what played out during the COVID-19 pandemic, right? So this example explains three situations. The first one that I want to draw your attention to is the gray line. So the gray line is if an investor put 100,000 Rand away in January 2020, and they left their money there, it would be worth 116,000 Rand, right? And as you can see there, it's a very smooth and stable, continual growth that happens in the money market. Now, the red line represents the Allan Gray balanced portfolio. So this client put 100,000 Rand in the Allan Gray balanced portfolio. And as you can see there, during COVID-19 in April 2020, the markets lost more than 34% of value, right? So if you were invested in any type of kind of like investment, you would have lost 34% of your money. But as you can see, their markets are cyclical and they turn. And what happened is the market started to recover and it continued to go up and down, right, as time went on. You can also see that during April 2022, we had a bit of a drawdown here. That was when we had the Russian-Ukraine crisis. So that's what I'm referring to. There's always going to be noise in the market that we need to filter out and just focus on what our investment is doing. Now, the black line represents a client that put 100,000 Rand away in the balanced portfolio, and when the markets went down, decided to withdraw their money, right? So they were losing a lot of money and they're like, oh no, I'm going to lose all my money. And they took their money out of the balanced portfolio and they invested it in the money market portfolio and they left their money there to continue, right? Then in about a year later, they decided, okay, the COVID pandemic is not really a thing. And they switched their money or their portfolio back into the balanced portfolio. And there it continued to grow. And then again, in April 20, a year later, we had the Russian-Ukraine crisis and the client withdrew their money from the portfolio and put it in the money market where it's a little bit more stable, right? And there you can see the returns on the money market. And what I want to draw your attention to in this graph is had the client remained invested and not worried or made any action on their portfolio, their money would have grown to 134,000 Rand. But because the client was switching in between portfolios the whole time, trying to decide when's the best time to buy, when's the best time to sell, he actually did worse off than he would have done even in the money market portfolio. And of course, if he had remained invested and stood the course of the investment period. So what are some of the tips to help you on this journey to financial success? The first one is to start with a plan. So what are your goals? What are your short, medium, and long-term goals? Your short-term goals could speak to having an emergency fund or a when life happens fund, which is kind of like what the COVID pandemic taught us, the importance of having an emergency fund and where we can, withdraw quite quickly and have that liquidity in our portfolio. Our medium-term need speaks to anything where we are saving for or investing for between 2 to 5 years, right? So this could be, saving for deposit on a house, saving for a deposit on a car, or perhaps saving for our children's education. And then if we have to look at our long-term needs, that speaks to our retirement saving or leaving a financial legacy for our loved ones. And here you're looking to invest for over 5 years. So consider first and foremost, what is your goal and how long are you looking to remain invested for? And the next tip that we have is to invest for above inflation returns, right? So we all know what a basket of goods costs us today is not what it cost us even 3 months ago, right? And that just refers to the rising cost of goods. That's what inflation is, the rising cost of goods, right? So what investing aims to achieve is to generate you a return that beats inflation. So you're actually growing your money over time, right? So I just want to draw your attention again to this graph. This graph has been adjusted for inflation. That means that all of these returns are over and above that of inflation. So these are real returns. And as you can see, the three bars, cash, bonds, and equities, right? Over different periods of time, equities always outperforms that of cash and bonds. But what it aims to show you also is that these are assets that will generate you inflation-beating returns. So it will generate you interest over and above inflation. And, you know, the key thing is to be invested for the long term, right? So what are your goals? You know, you might be someone that might not want to invest for the long term. Maybe you want to invest for the short term, and you also need to consider what is your risk appetite. So are you someone that's going to be worried about what their money's doing like every single month? Or are you someone that wants to take on a bit of risk and understands that markets do go up and down in the short term, but in the long term, shares tend to deliver an inflation-beating return? The next tip that I can show you is to start early to benefit from compound interest. Now, compound interest is where you earn interest on top of your interest. So that is where your money is working for you. And what this shows you is if you had contributed R1 at different periods of your life, right? So if we started investing R1 at the age of 25, by the time we retire at 65, our money would be worth R30. And the later you start investing, the less time that money has to grow and compound, right? So as you can see there, you know, if you had to invest at age 35, your money would only grow to just under R15. And then it gets less and less as time goes on. So people often ask me the question, you know, when is the best time to start investing? The best time is now, because the less, you know, the later you leave it, the less time your money has to grow and earn interest on top of interest in the market. So what are some of the things that, or the products, accounts that we offer at Allan Gray? So we have different accounts or products. Those all mean the same things: accounts, products. And what these accounts do is they house our money, right? So this is where our money sits, and each of these different accounts has its own set of rules and regulations which govern it, and it also depicts when you will have access to your money. So this is just where your money sits. Our first account is a basic unit trust account. So what is a unit trust? A unit trust is a type of investment vehicle where people pool their money together, and we are able to, with all the money that we have, we are able to buy, as Allan Gray, different, and any dividends or any interest that those companies make, we then pass that through to our clients in their various investment accounts. Now we have a unit trust account. What is this? It's an investment vehicle. It is flexible. So what that means is you have access to these monies anytime that you want, right? You can put money in, you can withdraw money without there being any penalties, right? And yeah, the basic thing about a unit trust account is that it is flexible. And then our minimum debit order at Allan Gray is R1,000. And if you want to invest in a lump sum, our lump sum minimum is R50,000. rand, right? So that is our basic unit trust account. And if you belong to a stock file, this is the investment vehicle that you would use in order to invest. The next type of account or product that we have is called a tax-free investment account. And I'm sure you've all heard of this. A lot of banks and institutions offer a tax-free investment account, and it's great because exactly what the word says, it is tax-free. So any money that you put into this account will grow free from any interest rate tax, any capital gains tax, and any dividends tax. So much like the basic unit trust account, although this one is tax-free, whereas the basic unit trust account, you will incur taxes, but that's over and above certain thresholds and limits, right? Which we all have as individual investors. So our tax-free account, one of the biggest, I guess, caveats is that you can't invest more than 36,000 Rand per tax year. So from the 1st of March to the end of February, you can't invest more than 36,000 Rand per year, but you can invest less than that, right? And then in your lifetime, you can't invest more than 500,000. As I said, one of the big benefits, it's one of the products that I love the most, is that you don't pay any tax on this, and you're able to nominate a beneficiary. So in the event of your death, whatever money is left in this account will pay through to your nominated beneficiaries. And again, it's also flexible, so you can put money in, you can take money out at any point in time. You won't incur any penalties or any fees. Our next account that we have is the Allan Gray Offshore account. So whilst our portfolios, like the Allan Gray Balanced Fund or the Allan Gray Balanced Portfolio, does invest some of its assets offshore, right? So we do get offshore exposure there. We also get offshore exposure depending on the different companies. We might invest in offshore companies. This type of account helps you to invest your monies directly offshore, right? So one of the benefits is that you can diversify your portfolio in terms of currencies as well as geographies and different market sectors. Again, much like the basic unit trust account, it's flexible, so you can put money in, you can take money out. And then the only thing about this one is we invest via lump sum, and that is a lump sum of 50,000 Rand, or if you have dollars or pounds, the dollar or pound equivalent. Right, and one of the caveats is we can invest R1 million per year as a single discretionary allowance. And if you want to invest anything over and above that, we need to obtain South African Reserve Bank approval. And the maximum that a South African investor can invest offshore is 11 million Rand. Our next account that we have is the Allan Gray Retirement Annuity account. I love this account as well. And the purpose of this account is to save for your retirement. So I often hear of people, saying, oh, they belong to a pension and a provident fund at work. That's great. But what we should be doing is we should be supplementing our retirement savings. So as Malalo said in the beginning, we have a very low savings culture in South Africa, with only 6% of South Africans being able to afford to retire one day. And a lot of people are dependent on the state, a lot of people are dependent on their families, and a lot of people are dependent to continue working, right? Why I love the retirement annuity account, also, any money that you put into this account is free to grow from taxes, right? So your money grows without incurring any taxes in this particular product. The only thing about this product is obviously it's designed for your retirement. So you can only access these funds once you reach retirement age. So that's at age 55. What's great about this account is any contributions that are made towards the retirement annuity account, that is tax deductible. So what does that mean? At the end of the year, when I do my tax returns, someone is going to see, oh, okay, you contributed to a retirement annuity. Let me give you some money for having done so. So it actually pays you for being invested in a retirement annuity account. And then again, you can nominate a beneficiary on this account, so any proceeds from this account get paid to your nominated beneficiaries in the event of your death. Yeah. And as I said, you can only access it at age 55, which is the legal retirement age. And then our last account that I'm going to talk to you guys today about is a preservation fund account. So as the name suggests, this is there to preserve our retirement savings. So often people change from one job to the next job. But if you have to look back at, what were these retirement savings for? It was to help you in retirement. So actually, we should be preserving those monies so that one day when we do retire, we have quite a big nest egg, and we can do that through what is called a preservation fund account. So it preserves your retirement savings, right? Also, any money that's put in here is free to grow from tax and dividends and things like that. And then you can nominate a beneficiary in the event of your death. Yeah, you do have a limited once-off withdrawal, so you can only withdraw from whether you have a pension withdrawal where you will pay tax on that income. Obviously, if you delay it for retirement, you'll have you'll have 500,000 Rand tax-free. Whereas if you're going to withdraw it now before your retirement, you only have 25, actually it's 27,500 Rand now, it's just increased tax-free. And then what happens at your retirement, right? So that's actually 550,000 Rand now. But at your retirement, once you retire, and SARS goes ahead and looks at, okay, let me see how many times this person accessed their retirement savings throughout their life. So that 550,000, if you were accessing money along the way, it's actually going to reduce that 550,000 tax-free that you'll have at retirement by however much you have kind of taken from your retirement savings throughout the years. So if you're accessing, say you access 100,000 Rand throughout your years up to retirement, instead of having 550,000 Rand tax-free, you're going to have 450,000 Rand tax-free because you've taken those little bits of money along the way. And it's also to encourage people, not to access their funds, to save for your retirement when you get there one day. And then I think this is my last slide. So we have a range of portfolios or funds at Allan Gray that cater to we believe to most financial goals, right? And any information that I give you here is factual, unbiased information. So whether it be with Allan Gray or another institution, I guess the information remains the same, right? So these are 4 flagship funds or portfolios. We have the money market fund, the stable fund, the balance fund, and the equity fund, right? And each of these funds are designed to deliver a particular return over a particular period of time. So our money market fund is invested in cash and cash-like instruments. So this is a great account if you're looking to save for the short term, and here you're looking to save for between 1 to 2 years. This will give you a better rate of return than you will get in your banking account, right? Then we look at our stable portfolio or our stable fund and our balanced portfolio or our balanced fund. So fund, portfolio, they all mean the same thing, right? What we call these 2 funds are multi-asset portfolios. So much like that graph that pie graph that I showed you earlier, these funds invest in cash, bonds, property, and equity. So they invest in that basket of assets. And depending on how how much equity exposure a particular portfolio has is how much longer you need to remain invested, right? So if you have low equity exposure, you don't need to be invested for that long. But if you've got a high equity exposure, you need to be invested for at least 5 years. So the stable fund invests in that basket of assets, but can invest up to 40% in equities. So because it invests up to 40% in equities, we suggest that you remain invested for between 2 to 3 years. In order for the fund or the portfolio to generate you the return that it promises, right? The balance fund has a little bit more equity exposure, and because it has a little bit more equity, we have to remain invested for a little bit longer. So the balance fund can invest up to 75% in equities, and here it's suggested that you remain invested for between 3 to 5 years. And then your equity fund, just like the name suggests, is invested solely in equities. So it is going to be a lot more volatile in the short term, but in the long term will give you inflation beating returns. So we don't want to have a case of, oh, okay, I'm going to put all my money in equity. If you're a person that is maybe risk averse and doesn't want to lose their money, and maybe someone that's not going to be invested for the long term, right? So you can invest in one of these portfolios, or you can invest in a combination of these portfolios. It's all up to you. But what first and foremost, what it comes down to is, what is my investment objective? What are my goals? And how long am I looking to remain invested? You can take your money out at any point in time, depending on which account you invested in. But obviously, in order for that portfolio to give you returns, it would need to remain invested for that specific period of time. Having said that, you know, your returns will increase. Maybe, you know, some of these portfolios pay out dividends monthly, some are biannually, some are yearly, right? So it just depends on when you know, which portfolio you invested in. But yeah, it all comes down to those two things. So in summary, we like to say, select a unit trust or portfolio or fund that is aligned with your goals, right? Invest for real above inflation returns, have a disciplined approach, and have a long-term mindset when it comes to investing, and use time to your advantage so that, you know, your money can compound and earn interest on top of interest as the years go on. So I'm going to leave you with this quote that says, someone is sitting in the shade today because someone planted a tree a long time ago. And whilst this rings true with investing, whilst it rings true with a lot of things in life, right? It definitely rings true when it comes to investing. So thank you everyone for your time and your patience. I really appreciate it. And yeah, if you've got any questions, you're welcome to unmute yourself. I'm going to check the question bar now. Yeah, thank you so much. Oh, I can't see the questions. Mulalo, I'm not.
Okay, not
going
a
to
problem.
stop sharing, and then maybe you can just you can let me know if there's any questions, or if anyone has any questions that you'd like me to answer.
Okay, thank you very much for the presentation. I'm sure that everyone that's here has benefited by being part of this session, because you simplified it and you also made it relatable, and also the different products that are available that people can be able to invest in. So in terms of the chat's functionality, there was just one question around whether an emergency fund is a savings account or investment account. But as you went through the slides, you indicated that she was answered. So I'm just
Awesome.
checking if anyone has a question, comment. You're most welcome to raise your hand, and then we'll give you a chance to comment or to ask a question, or even share about your experience when it comes to investing. There's a question that says, what maximum is it? 50K, 15K?
So our debit order is R1,000, and then our lump sum. So if you just want to put a lump sum of money in our investments, it's 50,000 Rand.
Thank you. Maybe just
so it's not the maximum, it's the I guess minimum amount. And as I said, the information that we provide is factual and unbiased. That is Allan Gray's minimums. But there might be other institutions that offer lower minimums where if that appeals to you, you can invest.
Okay, thank you. Any other question, comment?
I see someone's asked, I have saved money for kids in a savings account. So I'm not sure what kind of savings account that is. The issue with us putting, I guess, money in our bank account or just leaving money in our bank account is, one, it's not earning interest, right? If anything, maybe you're getting like a 2% interest on a positive balance on your banking account. But inflation now is currently sitting at 7.5%. So if you earn 2%, but inflation is sitting at 7.5%, over time, you're actually losing purchasing power on that money. So your money is actually decreasing by 5.5%. And that's why it's so important to invest in different types of assets. Because what portfolio managers such as ourselves aim to do is to provide above inflation returns. So if inflation is sitting at 7.5%, we want to give you 7.5 plus 2 or 7.5 plus 5, depending on what those particular portfolios or mandates are, right? Each of those funds have their own kind of like goal or aim, and they say, okay, this is what I want to achieve for my clients. So every institution has what we call fund fact sheets. And what that does is provide you an in-depth kind of information on each of those portfolios. Who is this suited to? What is the risk profile? What is the investment time horizon? Which companies are we invested? Are we invested locally? Are we invested offshore? So all of this information is available on a more in-depth level called, and we put that information on what is called a fund fact sheet, where you're able to read and learn more about that particular fund or portfolio that you are invested into. And then, obviously we understand that sometimes this is quite cumbersome. Sometimes we don't want to make these decisions on our own. And that's where you have the likes of Mulalo. We have trusted independent financial advisors. So we don't have any financial advisors at Allan Gray because we believe that investments should be bought and not sold, right? But if you feel like, you need some help, you need someone to guide you along the way, then you would look for an independent financial advisor. So someone that's not tied to kind of like sell you a particular product or whatever just for the sake of, right? They're looking at your needs as well as, what it is, what is best suited to you as an individual. And that is where the expertise lies and where you can get tremendous value in I guess going on this journey with an independent financial advisor. Thanks for the comments, guys. I really appreciate it. I'm still paying off my student loan. What's the biggest priority? Paying off my loan or starting to invest? We also always get that question. Mulalo, I don't know. What's your take on it? What would you say?
For me, when it comes to those two options, I would say the best way is to build your emergency fund. in case of an emergency. And then the second goal would be paying off debt. So before we go to investing for other goals, the emergency fund needs to be there, and then you can prioritize the paying off of the debt. Because if you compare the interest that you earn when you are investing and the interest that you're paying when you have a debt, in most cases, the interest on the debt is usually higher than what you're earning while investing. But before you invest or before you tackle the goal debt, make sure that the emergency fund is there, because if it's not there, something happens, you're going to get into more debt in order to be able to cover that emergency. But we are available, as you've said, to walk the journey with you, and then also assist you to put together a plan that is flexible, a plan that speaks to where you are and where you want to go.
Awesome.
There was another question with regards to if it's the debit order. So the debit order can go on as long as you want it to go. So you've got the flexibility to even pause the debit order and then start again. And then if you want to top up on the investment, you are able to top up on your investment. So we'll be able to assist you with that as well. There's a question that I'm gonna hand over to you from Malebo with regards to the difference between an endowment policy and unit trust, and which one is best for the children's education.
Awesome, that's a really great question. If I can just go back to that debit order question. So the debit order is R1,000, right? Once your account is open, so your account, you'll open an account at Allan Gray, you'll have your own online profile, just like a banking profile. Then you can put any money into there, right? So it doesn't have to be a 50,000 Rand addition. It can be 10,000 Rand, 5,000 Rand, 2,000 Rand. Additional contribution. But if I'm going to start my account and I want to put a lump sum in, it's 50,000. So you don't have to. What I'm saying is, you can open your account with R1,000 Rand debit order, and like Malala said, if people do run into issues, you can pause your debit order. So we don't encourage you to stop your debit order, but you can pause it for a few months until you get yourself back on the track, and then you can continue your debit order. And then if you want to pump, if you get windfalls of money or anything like that, you can put that money into that account. That money, an additional contribution, doesn't have to be 50,000 Rand, just the initial. And then, great question, Malebo. So I actually didn't touch on the endowment policy or endowment account in this instance. I think while endowment accounts are encouraged for saving for children's education is because they are locked, right? So you can't access that. They have a 5-year term, right? So you can't access those monies for 5 years. But I think one of the biggest benefits of an endowment policy is that you actually pay tax at a lesser rate, right? Having said that, you need to be earning the tax that you pay, or your income tax bracket rather, needs to be over 30%. If you are earning an income where your income tax bracket is less than 30%, then it doesn't make sense being invested in an endowment policy. So it's actually there to save you in terms of tax if you are a very high earning individual and you are at the highest income tax bracket. If you are not at the highest tax bracket, you're actually paying a higher rate of tax than you would being invested in a basic unit trust account or even a tax-free investment account for that matter. So make sure, that, I guess, that is looked into. And as I said, the reason why people offer these endowment accounts is because they're term policies. So if you feel like you are someone that's not going to be disciplined along the way, right, for saving for your children's education, and you're always going to put your money in that cookie jar, then yes, an endowment policy might work for you, but that is provided that you are at the highest kind of like income bracket. If not, then I would suggest just using a basic unit trust account for your children's education, and to be a little bit more disciplined. So put the money there and kind of don't like obviously put your hand in the cookie jar, because that's what those funds were intended for. So yeah, that's a big thing that you need to take note of with endowment policy. So, and remember, so the account is what houses your money and what has a set of rules. So that's the rules of the endowment. It's a 5-year term endowment. And then which portfolio or which fund that you are invested in is what actually pays you a return. So that's what generates you interest every month.
Okay, thank you very much, Emanuela. Unfortunately, we will have to cut the session here. It's 9 o'clock. I've got another session to jump into as well.
Awesome.
But I just want to say thank you for taking the time to come and engage with us and share this information. And for those that have joined us for making time, this is a great success. Having 25 people on a Thursday morning, 8 o'clock. You're up and you're investing the time on your own financial education. So well done on doing that. And thank you for choosing yourself. And for those that still want to watch the recording, we'll make it available on the EmpowerX Advisory Services YouTube channel. And I've noted some of the questions here that have been posed, and then we will attend to them. There's a question around overdraft. So when we do the next session on using credit wisely, we tackle that. And I'll also refer you to last month's monthly money meeting where it was on using credit wisely. And there's a comment to say from someone who say they have an Allan Gray account, and then it's a great decision that they've made. And thank you for the informative session. And then people are saying thank you. This was easy to understand and simplified for someone like them, very informative and relatable.
Awesome.
And then we really need this information. So there is a need for more sessions on financial literacy education. And thank you for making the time. And we will communicate with everyone that has registered. And if you're watching this later on, you can reach us on info@empowerx.co.za, and then we'll be able to assist you and then be able to walk this financial journey with you. As I said in the beginning, we believe in your ability to make great financial decisions. We believe in empowerment through education, and we walk the financial journey with you. So this is an invite to say, reach out should you need any assistance. If there are any questions that you need clarity on, we are happy to walk the journey with you. With that said, thank you very much and have a blessed Thursday.
Thanks, Malalo. It was
Thank
amazing.
you.
Bye, everyone.